Welcome to Talk Tickers.
Hey, it is great to be here.
Usually when we fire up the mics for Talk Tickers, we are really deep in the weeds of the daily market grind.
Yeah, the day-to-day chaos.
Exactly. We are dissecting earnings calls from the tech giants, or we're debating whether the Fed is going to cut rates by 25 basis points or hold steady.
Right.
We're usually obsessing over that ticker tape scrolling across the bottom of the screen. I mean, we love the noise. We love the action.
We do. That is the heartbeat of the market. It is, it's what keeps us employed.
It is. But today, I really want to do something completely different. I want to step away from that quarterly cycle.
Okay.
I want to ignore the noise for an hour, because today we are not looking at a specific stock ticker. We are going to look at the ticker of your entire financial life.
The big picture.
The biggest picture. We're going to do a deep dive into a critical financial mechanism that, quite frankly, is the single most important factor in whether you retire on a yacht or you retire in your guest bedroom.
That sounds dramatic, but it is mathematically accurate.
And the scary part is, this mechanism really doesn't care how good you are at saving.
Not at all.
You could be the most disciplined saver in the world. You could max out your 401k every single year for 30 years. You could invest in low-cost index funds and do everything right by the book.
All the standard advice?
Yeah, all the standard advice. And yet, you could still find yourself completely broke in your 80s because of this one specific mathematical reality.
Yeah, it is the silent killer of wealth. I mean, most people never see it coming until it is way too late.
We are talking about sequence of returns risk.
Or SRR, as the nerds like to call it.
Right, SRR. So let's set the stage here. If I had to give the elevator pitch of this problem, like the basic summary for you listening right now, it basically boils down to this. There's a massive, massive difference between the accumulation phase of your life and the decumulation phase.
There are two completely different universes with entirely different laws of physics.
Right. For 40 years, while we are working and saving, we are trained to focus on one metric: average returns.
Just hit the average.
Exactly. If the S&P 500 does 8% or 10% on average, we are happy. We plug that number into a compound interest calculator online, we see a big number at the end of the graph, and we feel safe.
And in the accumulation phase, that logic actually holds up. It works.
It does.
If the market crashes while you are 30 years old and you're contributing to your 401k every 2 weeks, that is actually good news. You are buying shares on sale.
You want that.
You want volatility. You want the market to be messy because you are a net buyer.
But the moment you retire, the very moment you stop adding money and you start taking money out,
the math flips upside down. Suddenly, the average return over a 30-year period is almost entirely irrelevant.
Completely irrelevant.
What matters, the only thing that actually matters, is the order of those returns, the sequence.
Because a market downturn early in retirement is mathematically devastating compared to a downturn later on, even if the final average return is exactly the same over 30 years.
It is literally the difference between leaving a multi-million-dollar legacy and running out of money before you die.
So the scope of our deep dive today is going to be incredibly comprehensive. We are going to start by defining the math of this risk. Why averages lie to us.
We have to break that down first so everyone understands the trap.
Exactly. Then we're going to move into the danger zone. We'll identify the specific window of time where this risk is at its absolute highest.
And we aren't just going to sit here and admire the problem.
No, we need solutions.
We are going to talk about defense. We are going to analyze specific mitigation strategies. We will cover things like bond tents, the bucket strategy, and dynamic spending.
And then later in the deep dive, we're going to get into some really fascinating, slightly more advanced territory involving volatility buffers.
This is where it gets really interesting.
It really does. We are going to look at how integrating insurance products like whole life and annuities can actually mathematically optimize a retirement plan better than just using investments alone.
It is going to be a complete journey from the problem to the solution.
Let's jump right into section 1, the math behind the risk. Why do averages lie? You have this great analogy that I think clarifies this perfectly, the river analogy.
Right. So imagine you are out hiking, you're out in the wilderness, and you come to a wide river that you need to cross to get back to your car.
Okay.
You see a sign posted by a statistician on the bank of the river, and the sign says, average depth, 3 feet.
Okay, well, I'm 6 feet tall, so if the average depth is 3 feet, I can just walk across that. I might get my shorts wet, but I'm certainly not going to drown.
That is the perfectly logical assumption based on the average. So you start walking, and the first 20 yards are ankle deep. Very easy going. But then, right in the middle of the river, there is a trench that is 20 feet deep.
And I step into it, and I drown.
You drown in the average river. The statistician wasn't lying to you. The average really was 3 feet across the whole width. But the sequence of the depth is what killed you.
Wow.
You cannot survive the average. You have to survive the specific reality of every single step you take.
And that is exactly what happens in a retirement portfolio. You cannot pay your mortgage with an average return.
No, you cannot.
You have to pay it with the actual money sitting in your account at that exact moment.
Precisely. And this leads us directly to the mechanics of why sequence of returns risk is so uniquely deadly. We call it the 1-2 punch.
Break that down for us. What is the 1-2 punch?
The first punch is the withdrawal itself. When you are retired, you have a burn rate. You have to pay for electricity, you have to buy food, pay property taxes, maybe you want to travel a bit.
The cost of staying alive.
Right. That money is leaving the account every single month, regardless of what the stock market is doing on any given Tuesday.
Okay, so the baseline is that the balance is naturally going down because I am spending it.
Right. Now, imagine the second punch, a bear market. The market drops 15% or maybe 20%. Now, your portfolio value is down significantly just from the market action.
So I have a much smaller pie.
But you still need the exact same slice of pie to eat.
Right.
Think about it this way. If your portfolio is worth $100 a share, you sell one share to get your $100 for groceries.
Makes sense.
But if the market crashes and those shares are suddenly worth $50, you have to sell 2 shares to get that exact same $100.
So I am forced to sell more of my assets just to maintain my basic standard of living.
Yes. We call this digging a hole. Because once you sell those extra shares at a loss, they are gone forever. They have permanently left the building.
And that is the absolute key, right? If the market recovers the very next year and goes up 20%, those shares I sold to buy groceries don't participate in the recovery.
Exactly. They can't compound if they don't exist anymore. You have permanently impaired your capital base.
It's brutal.
It is the exact opposite of dollar cost averaging. In the accumulation phase, you buy more shares when the market is down. But in the de-cumulation phase, if you aren't careful, you are forced to sell more shares when the market is down.
It is a death spiral.
It is a spiral that rapidly accelerates the depletion of your money.
Let's make this really concrete with a case study from the research. The data provides a perfect tale of 2 investors. Let's call them Susan and Bill.
Susan and Bill are the perfect laboratory examples for this. Let's assume they are identical in almost every conceivable way. They have the same risk tolerance, they use the exact same investment strategy, and they have the exact same spending needs in retirement.
But their starting balances are different, right?
Yes. Susan is our star saver. She has accumulated $2.5 million. Bill, on the other hand, has accumulated $2 million.
So Susan is starting retirement with a massive $500,000 lead over Bill. She is way ahead of the game.
She is in great shape. And they both decide to follow the standard financial advice that everyone hears. Withdraw 4% of the initial balance, and then just adjust that amount for inflation every year.
Right, the classic 4% rule. So Susan withdraws $100,000 a year. Bill withdraws $80,000 a year.
Exactly. Now, here's the twist. We are going to run a 30-year simulation for both of them. We are going to give them the exact same set of annual investment returns, the exact same 30 numbers.
Okay, so they experience the exact same market performance over their retirement.
Yes, but the only difference is the order. We are going to reverse the sequence. Susan gets the returns in order A, Bill gets the returns in order B.
So at the end of the 30 years, their average return is mathematically identical.
Identical down to the decimal point. But Susan is unlucky. She retires into a bad sequence. Let's say year 1 of her retirement is a market crash. The portfolio is down 20%.
Ouch. Let's walk through Susan's math on that. She starts with $2.5 million. The market drops 20%. That is a $500,000 loss on paper right off the bat.
Plus, she withdraws her $100,000 for her living expenses. So at the end of year 1, her balance isn't $2.5 million, it is $1.9 million.
She lost $600,000 in 12 months.
Yes. She lost nearly 25% of her total wealth in her very first year of retirement.
That is terrifying.
Now think about the immense pressure on that remaining portfolio. She still needs to withdraw that $100,000 plus a little more for inflation next year.
Right.
That $100,000 withdrawal now represents a much, much larger percentage of her remaining $1.9 million pot.
The effective withdrawal rate just spikes.
She is spiraling immediately. The analysis shows that even if the market goes on a massive historic bull run later in her retirement, it doesn't matter.
Because the hole is too deep.
Her capital base was decimated too early. Susan runs out of money in roughly 25 years. She dies broke.
Despite starting with $2.5 million and a 4% withdrawal rate. That is insane. And what about Bill?
Bill is the lucky investor. He retires into a roaring bull market. His sequence starts with the really good years. Year 1 is up 25%.
So he withdraws his $80,000, but his account actually grows significantly.
Right. Because his account grows so much in those early years, his flat withdrawals represent a smaller and smaller percentage of his total wealth.
The math is working in his favor now.
By the time Bill hits the bad years, and remember, he faces the exact same bear market that Susan did, just at the end of his 30-year window instead of the beginning, it doesn't matter.
He has so much money piled up by then that a 20% drop is just a scratch on the surface.
Exactly. Bill ends up not just surviving, but thriving. He leaves a massive legacy, millions of dollars left over for his heirs.
That is absolutely wild. They had the exact same average return, the exact same strategy. One goes broke, one becomes a multimillionaire.
And the only difference was the year they happened to cut the cake at their retirement party.
That feels incredibly unfair. It makes financial planning feel like a visit to a casino.
It is what we call generational luck. And we see this in real history, not just in these neat little spreadsheet simulations. There is the really famous historical comparison of the 1973 retiree versus the 1974 retiree.
Right. 1973 was a brutal year. You had the oil crisis, stagflation was beginning, the Nifty 50 crash.
It was awful. If you retired in 1973 with a standard 50-50 portfolio of stocks and bonds, you faced immediate heavy losses. The historical data shows that specific retiree runs out of money in about 23 years, they are left destitute.
And if you retire just 1 year later, in 1974,
you face the exact same long-term economy. You live through the exact same high inflation of the late 70s. You live through the same crazy interest rate spikes under Paul Volcker. But because you missed that initial catastrophic drop in 73, and you started your withdrawals when the market was already beaten down and recovering, you ended up with a massive surplus.
1 year. Literally 12 months determines whether you were eating cat food or caviar in your 80s.
That is the ultimate cruelty of sequence of returns risk. Short-term pure chance can dictate your financial survival far more than decades of disciplined saving.
This leads us directly to section 2 of our deep dive. We really need to define the when. Is this a risk for the entire 30 years of retirement? Or is there a specific window we really need to worry about?
We call this the retirement red zone.
Like in football, when you're inside the 20-yard line and things get intense.
Exactly. It is the high-stakes area. The red zone is typically defined as the decade immediately leading up to retirement and the decade immediately following it.
Why the decade before? You aren't withdrawing money yet.
Because if the market crashes right before you retire, your nest egg shrinks dramatically right when it's supposed to be at its largest, and you might have to delay your retirement entirely.
Makes sense.
But for SRR specifically, the mathematical risk of running out of money while withdrawing the analysis suggests the first 10 to 15 years of retirement are the absolute critical window.
So if you retire at 65, we are talking about age 65 to 80.
That is the window where the game is definitively won or lost.
We have some correlation data on this from the sources that is pretty mind-blowing.
Yes, it really puts it in perspective. If you look at the success of a 30-year retirement plan, the final outcome, whether you have money left or not, is highly correlated to the investment returns of just those first 15 years.
What's the number?
The correlation coefficient is 0.91.
Wow. For those who maybe skipped statistics class in college, a 1.0 is a perfect match. So 0.91 is incredibly high.
It means they are almost entirely synonymous. If the first 15 years are bad, the entire 30-year plan fails. If the first 15 years are good, the plan succeeds. It is that simple.
And what about the investment returns in the final 15 years, years 16 through 30?
They have almost zero correlation to failure.
Really? Almost zero. Why is that?
Because of the dual forces of compounding and depletion. If you have survived the first 15 years without drawing down your principal too much, and your portfolio is still really healthy, the compounding of that larger pile of money is powerful enough to withstand almost any late-stage crash.
The momentum is too strong.
Exactly. Conversely, if you are broke at year 15, no amount of a roaring bull market in year 20 can save you because you have absolutely no money left in the market to invest.
You're out of chips. So the primary goal of any retirement plan should really just be survive the first 15 years at all costs.
Exactly. Survive the red zone. Everything else is secondary.
We categorize retirees into different types based on this timing risk. The research talks about full bear market retirees and partial bear market retirees.
Right. A full bear market retiree is the person with the absolute worst possible luck. They retire at the exact peak of a market bubble. Think about the folks who retired in 1929, 1966, 1973, or the year 2000.
Terrible timing.
They experienced the entire peak-to-trough decline while they're simultaneously withdrawing money.
And the numbers on this are just staggering.
If these people maintain a fixed spending strategy, just blindly pulling out 4% plus inflation, their portfolio declines can hit 94% in real terms.
94%.
They are effectively wiped out.
And then what about the partial bear market retiree?
This is someone who maybe retires a year or two before the crash actually hits, or maybe right as the crash is ending and things are bottoming out. They have a bit of a cushion.
Right.
Either they had some portfolio growth before the drop happened, or they started with lower market valuations, so the drop wasn't as severe. Their outcomes are significantly better.
There is another aspect to this danger zone that isn't just about the financial spreadsheet. It's heavily psychological.
Yes, very much so. We talk about this concept called underwater duration.
Explain that concept for us.
Most people just ask the binary question, did I run out of money before I died? But we should really be asking, how miserable was I while I still had money?
Quality of life.
Exactly. Underwater duration measures how long your portfolio value stays below your initial starting balance.
So if I retire with $1 million and the market drops it to $800,000, underwater duration is how long it takes until I see $1 million on my monthly statement again.
Exactly. And for those full bear market retirees we just talked about, the average underwater duration is 34 years.
34 years. That is the entire retirement.
It is a life sentence of financial stress. Imagine retiring at age 65. The market drops. You are 70, then 75, 80, 85, 90.
Yeah.
And every single month for those 3 decades, you open your brokerage statement and you see a number that is lower than what you started with. You are constantly worried. You're always asking yourself, is this the month I finally go broke?
Even if the spreadsheet retroactively says you technically survived by the skin of your teeth, that is a deeply miserable way to live your golden years.
It destroys your quality of life. You stop spending money on things you actually enjoy, travel, hobbies, spoiling your grandkids because you are just utterly terrified. So solving SRR isn't just about mathematical solvency. It is about preserving your peace of mind.
Okay, well, we have thoroughly terrified everyone listening. We have defined the brutal math, we've identified the danger zone, and we've looked at the severe psychological toll. Now, let's pivot to the solution. Let's get to section 3, portfolio construction strategies. This is the defense.
This is where we actually take back control. We obviously can't control what the market returns are going to be, but we can completely control how we allocate our assets to handle whatever happens.
One of the most popular strategies out there, and one that is very intuitive for a lot of people, is the bucket strategy.
The bucket strategy is great mostly because it matches the way human beings actually think about time and money. It involves deliberately segmenting your money based entirely on when you're going to need to spend it.
So instead of just looking at one big pile of money in an account, you have these distinct mental or physical buckets.
Right. Bucket 1 is your short-term or immediate bucket. This typically holds 1 to 3 years of your actual living expenses. The entire goal of this bucket is safety and absolute liquidity.
So what exactly are we buying inside bucket 1?
Cash, pure cash, money market funds, certificates of deposit or CDs, maybe some very short-term treasury bills.
Zero risk stuff.
Exactly. Things that will absolutely not lose a penny of nominal value if the stock market crashes tomorrow.
So if the S&P 500 drops 50% on a random Tuesday, bucket 1 is completely unaffected.
Correct. And that is the psychological anchor you need. You know, with absolute certainty that your mortgage payments and your grocery bills for the next 3 solid years are already paid for and sitting in cash. You do not have to panic.
Okay, then we have bucket 2.
Bucket 2 is the medium-term bucket. This is money you'll need in years 3 through 7, or maybe extending up to year 10. This is where you put your high-quality bonds, your fixed income, maybe some really stable dividend-paying stocks.
You're looking for some yield here.
You want stability, but you also need income. You essentially use the yield from bucket 2 to constantly refill bucket 1 as you spend that cash down.
And finally, bucket 3.
Bucket 3 is the long-term bucket. This is for years 10 and beyond. This is your primary growth engine: stocks, equities, real estate. This is the money that absolutely has to outpace inflation over the next 30 years.
And the logic here is pretty simple. If a brutal bear market hits, it really only hits bucket 3.
Exactly. And because that is your 10 years from now money, you frankly don't care. You don't have to sell a single share of it. You just keep spending from your safe bucket 1. You keep refilling from the stable bucket 2.
Right.
And by the time you actually need to touch the assets in bucket 3, history strongly suggests the market will have had plenty of time to fully recover.
It effectively builds a physical bridge over the bear market so you don't fall in.
It creates a time buffer. It prevents you from ever being a forced seller of depressed assets.
Is there a downside to the bucket approach, mathematically speaking?
Yes, there is what we call cash drag. Holding 3 full years of expenses in cash, earning maybe 4 or 5%, or historically even less, means that significant chunk of money isn't growing in the stock market.
Right.
Mathematically, a strict bucket strategy often slightly underperforms a simple, constantly rebalanced total return portfolio. But behaviorally, psychologically, they are pure gold. They keep people from panicking.
Now let's talk about a slightly more technical strategy that I find really fascinating: the bond tent. I just love the visual of this one.
The bond tent is clever because it addresses the specific timing of the SRR risk perfectly. Imagine a simple line graph charting your bond allocation over time.
Okay, I'm visualizing it.
When you are 40 or 50 years old, your bond allocation is very low. The line is flat near the bottom. You are mostly in stocks because you are optimizing for maximum growth.
Right.
But as you approach retirement, say, starting 10 years out, you actively start ramping up your bond allocation aggressively. The line on the graph goes up sharply, creating the left slope of a tent.
So the tent pole, the absolute peak of the bond allocation, is the exact day you retire.
Right. On the literal day you retire, you might be 60 or even 70% in bonds. You are hyper-conservative. This heavily protects the nest egg at its most vulnerable moment.
And then what happens after the retirement party?
Then, as you move through those highly critical first 10 to 15 years of retirement, the red zone we talked about, you intentionally spend down those bonds. You sell the bonds to create your living income instead of touching the stocks.
So the bond allocation on the graph slopes steadily back down, creating the right side of the tent.
Yes. And here is the really interesting part mathematically. Because you are constantly selling off your bonds to live, but you are deliberately holding on to your stocks, your percentage of stocks in the overall portfolio actually increases as you get older.
It creates what's called a rising equity glide path.
Exactly.
Now that seems completely counterintuitive to everything we were taught. Conventional wisdom always says age equals bond percentage. You are supposed to get safer and safer as you get older.
Conventional wisdom is worried about you running out of time to recover. Sequence of returns logic is worried about you running out of money early. The math clearly shows that once you successfully survive the red zone without depleting your capital base, you have won the game. You can actually afford to take much more risk later in life. You need the massive defensive shield right at the transition point.
That makes total sense when you frame it around the red zone. However, we have to address the giant elephant in the room regarding bonds. Both the bucket strategy and the bond tent heavily rely on bonds functioning as a safe asset.
And the year 2022 absolutely blew that foundational assumption completely out of the water.
The 2022 exception.
Usually stocks and bonds are negatively correlated. It is like a seesaw on a playground. When stocks go down and people panic, investors flee to the safety of bonds, which drives bond prices up. They balance each other out beautifully.
But in 2022?
In 2022, inflation spiked violently, so the Fed had to raise interest rates incredibly aggressively to fight it. And when interest rates go up, existing bond prices mathematically have to go down. Right. So we had this nightmare scenario where stocks crashed because the economy was teetering and bonds crashed simultaneously because of the Fed rate hikes.
There was literally nowhere to hide in a traditional portfolio.
Exactly. If you're sitting inside a beautifully constructed bond tent in 2022, your tent completely collapsed on top of you. You might have seen double-digit losses in the exact money that was supposed to be completely safe.
This really highlights the severe limitation of traditional asset allocation. If stocks and bonds can fall together at the exact same time, the math of these defensive strategies just breaks.
Which is exactly why we need to move to Section 4, behavioral mitigation. If the portfolio construction itself cannot guarantee it will save us, our own habits have to step up.
We are talking about dynamic spending here, the adaptive approach.
The traditional 4% rule is incredibly rigid. It essentially says, blindly withdraw the exact same inflation-adjusted amount every single year, no matter what the stock market is doing, no matter what the economy is doing. It is putting your finances on autopilot.
And dynamic spending says, grab the steering wheel.
Right. Pay attention to the road. If the portfolio drops significantly, you actively cut your spending. If the market eventually recovers, you can safely increase it again.
But how much of a cut are we talking about here? Are we talking about starvation diets, selling the house?
No, not at all. The data from Vanguard on this is really reassuring. They found that even for the absolute worst case scenarios, those full bear market retirees who hit the 1929 or 1973 buzzsaws, using a dynamic approach required an average income reduction of only about 4.5% in the early years.
4.5%. Okay, so if you were planning on spending $100,000 that year, you spend $95,500 instead.
Right. It is the difference between taking a European vacation and maybe just doing a domestic road trip that year. It isn't a catastrophic change to your lifestyle, but the mathematical impact on the portfolio's survival is massive.
What does the Vanguard data actually say about the outcome?
Vanguard found that dynamic spending can virtually eliminate the risk of portfolio depletion entirely, even for a 1929 or 1973 retiree.
Wow.
By taking that small, disciplined cut early on, you completely avoid digging the hole we talked about. You preserve enough of the capital base so it can actually catch the recovery.
Remember we said under a rigid, fixed spending strategy, those unlucky portfolios dropped 94%. Under dynamic spending, what was the drop?
The maximum decline was reduced to around 71%.
Still painful, obviously.
Very painful, but you stay in the game. You don't go to absolute zero, you survive.
There is also a formal monitoring strategy mentioned in the research called ex ante.
Yes. This concept comes from the IS Business School. It basically says, don't just set a withdrawal rule on day one and completely forget about it for 30 years. You need to periodically stress test your plan.
Like an annual medical checkup, but for your money.
Exactly. Once a year, you look at your current portfolio balance, you look at your remaining life expectancy, and you ask a simple mathematical question. Is my current withdrawal rate still sustainable based on these new numbers? If the answer is no, you adjust.
And they have a specific defined threshold for when you actually need to act, right?
They call it the substantial threshold. If your annual math says you need to cut your current spending by more than 10 to 15% just to remain solvent, that is the giant red flag.
That's the alarm bell.
That means sequence risk has officially hit you hard and you need to make a lifestyle change immediately.
But their general vibe throughout the research paper is very much don't panic.
Right. They constantly remind us that total catastrophic failure is actually quite rare historically. You shouldn't obsess over shark attacks, which is what they call those extreme 1929 scenarios. You shouldn't ruin your retirement worrying about them every day.
Just have a plan.
Just have a concrete plan for what to do if you happen to see a fin in the water.
Okay, so we have covered structure with buckets and tents. We have covered behavior with dynamic spending. Now, I really want to move to Section 5. This is where we break out the heavy artillery, the volatility buffer.
This is where we completely step outside the traditional world of investment science and we start utilizing actuarial science.
We were talking about formally integrating insurance assets into the retirement portfolio. Specifically, whole life insurance, cash value, and annuities. Now, I know the immediate reaction from many listeners the second you say that. Whole life insurance. Are you kidding me?
Oh yeah, people are rolling their eyes right now.
We are aggressively taught by almost every popular financial guru on television and podcasts to buy term and invest the difference. Avoid whole life at all costs.
Right. The fees are too high. The commissions to the agents are high. The internal returns are much lower than the stock market. Why on earth would we even consider this for a smart retirement plan? And you know what? for the accumulation phase of your life, those critics are usually absolutely right. Buy term and invest the difference is a phenomenal, proven strategy for building wealth in your 30s and 40s. But in the decumulation phase, the fundamental goal changes completely. We aren't looking for maximum return on investment anymore. We are looking for non-correlation.
We need an asset that emphatically does not move in tandem with the stock market or with interest rates.
Exactly. We just saw how supposedly safe bonds completely failed in 2022 because they are tied to interest rates. Whole life insurance cash value does not have that vulnerability.
Explain the actual mechanics of how cash value acts as a buffer.
Think of it as a highly supercharged cash bucket.
Yeah.
The cash value sitting inside a properly structured whole life policy is contractually guaranteed to grow every year. It literally never has a negative year. It cannot go down in value just because the stock market crashes.
And unlike a traditional bond fund, if the Fed raises interest rates, the value of that cash doesn't drop.
In fact, over a long timeline, rising interest rates usually lead the insurance company to pay higher dividends to policyholders, so it actively helps.
That's a nice perk.
But the absolute key is the stability. It acts exactly like a short-term cash equivalent in terms of safety, but historically it yields something much closer to a long-term corporate bond. It's a sweet spot.
So how do we actually deploy it to fight the 1-2 punch scenario we talked about earlier?
We use what's called the bridge strategy. Let's say you retire. Year 2, the stock market crashes 20%. Instead of selling your stocks at a painful loss, which is punch 2, instead of selling your bonds, which might also be down,
Right.
you completely stop all withdrawals from your investment portfolio entirely.
You just freeze the portfolio.
You put it in a deep freeze, you turn to your whole life policy instead, and you take out a policy loan. You are effectively borrowing against your own death benefit.
And these policy loans are tax-free, right?
Under current law, usually, yes, they are completely tax-free. You take that borrowed money and you use it to pay your bills and buy your groceries for that entire year. You live on the insurance company's money. This gives your bleeding stock portfolio the crucial time it needs to recover.
You are entirely avoiding being a forced seller.
You are avoiding the sale at the worst possible time. Then, say 2 years later, when the bull market inevitably returns and your portfolio is back up to new highs, you simply resume your normal withdrawals from the portfolio.
And the loan.
You can even take some extra withdrawals from those market gains to pay back the loan to the insurance company, completely recharging your volatility buffer for the next crash.
It honestly seems almost like a magic trick. You are just cleanly swapping the source of your income back and forth based entirely on market performance.
It is called source of returns management. And the mathematical simulations on this in the research are absolutely fascinating.
Walk us through those specific scenarios.
Okay, scenario 1 in the data is investments only. You just have stocks and bonds. Because you have absolutely no external buffer to save you, you have to be highly conservative with your spending rate right from day 1 to make sure you don't run out of money if a bad sequence hits.
Right, you have to live smaller.
Yeah.
What about scenario 2?
Scenario 2 introduces the volatility buffer. By having that whole life cash value sitting there available, you can actually start your retirement with a significantly higher withdrawal rate from your main investment portfolio.
Wait, hold on. Having the boring low-yield insurance policy actually lets me be more aggressive with my stock portfolio.
Yes, because you have a guaranteed safety net. You don't need to drag your portfolio down holding massive amounts of cash or low-yield bonds just to dampen volatility, because the insurance policy itself is the dampener.
That is brilliant.
So you can confidently hold a much higher percentage of stocks in your main portfolio, which ultimately drives much higher long-term growth.
Then there's another strategy in the research called the covered asset strategy, which involves annuities.
This one brilliantly addresses what economists call the annuity puzzle. See, academic economists absolutely love annuities because of something called mortality credits.
Mortality credits, what is that?
It is the mathematical reality that the money left behind by the people in the annuity pool who die early naturally subsidizes the payouts to the people who end up living a very long time.
Okay.
It creates a guaranteed yield that is mathematically higher than what you can safely get from a standard bond portfolio. It guarantees you a paycheck for as long as you live, no matter what.
It sounds great in theory, but in practice, regular people absolutely hate buying them.
Because they hate the idea of losing their principal. If I take $500,000 of my hard-earned savings, I buy an annuity, and I accidentally step off a curb and get hit by a bus tomorrow.
The insurance company keeps all the money. My kids get absolutely nothing.
Exactly. It feels like a terrible bet. So how does the covered asset strategy fix this psychological block? You use the whole life death benefit to cover the risk. You take a portion of your retirement savings and you buy a single premium immediate annuity, or a SPIA. That generates a very high guaranteed income floor that covers all your baseline living expenses forever.
But what about the legacy for the kids?
The life insurance policy completely replaces the wealth. When you eventually die, the tax-free death benefit pays out directly to your heirs, perfectly replacing the $500,000 you spent on the annuity.
Wow. It completely removes the fear. It gives you permission to actually spend down your assets while you were alive.
Exactly. It unlocks the power of the annuity without the guilt of disinheriting your family.
And finally, there is the double duty scenario.
This is scenario 5 in the simulation research. You combine absolutely all of it into one master plan. You use the annuity to create your unshakable income floor, and you use the life insurance cash value strictly as a volatility buffer to protect your remaining stock portfolio during market crashes.
What is the final impact on spending for the retiree in that scenario?
This specific strategy mathematically supports the highest median spending of all the scenarios they tested. It allows for up to 62% more spending power than an investments-only approach.
62% more spendable income. That is massive. That is the difference between driving a 10-year-old used Chevy and leasing a brand new Mercedes every 3 years. That is the difference between camping in a state park and staying at the Ritz.
It is life-changing. It completely transforms the lifestyle possibilities of the retiree.
But there has to be a trade-off. There is no free lunch in finance.
There is always a trade-off. This specific double-duty strategy is heavily optimized for maximum spending while you are alive. As a result, it significantly reduces the final legacy left behind. You are efficiently consuming much more of your total wealth.
Which, if you belong to the die with zero crowd, is exactly the point of the whole exercise.
Precisely. But if your personal goal is to be the next Vanderbilt and leave a massive multi-generational endowment, the pure volatility buffer strategy without adding the annuity is often mathematically better because it preserves the core capital so effectively over time.
Let's move into section 6 as we start to round this out. Implementation and trade-offs. We really have to talk about taxes because that changes the math on everything.
This is where the insurance strategy gets yet another massive boost. As we mentioned, cash value distributions up to the total amount you actually paid in premiums are completely tax-free, and policy loans are tax-free.
Why does that matter so much for a retiree specifically?
Because of provisional income. The IRS looks at your total combined income from various sources to decide exactly how much of your Social Security benefits they are going to tax.
Ah, right. The infamous stealth tax on retirees.
Exactly. If you can strategically source your living income from a tax-free policy loan during a year where you really don't want to show high income to the IRS, you can artificially lower your provisional income.
And that protects your Social Security.
This might keep your Social Security completely tax-free that year. It significantly increases your true net spendable money.
But we do have to honestly address the upfront cost here. Premiums for whole life policies are very expensive compared to term life. We aren't hiding that fact.
They absolutely are. You are explicitly paying for that bulletproof safety. And the critics will always say, well, the insurance company's just keeping all the profits. You should keep them yourself.
But the simulation research suggests the overall efficiency of the integrated plan actually beats the DIY approach.
It does. And the reason why is actually pretty simple once you understand the macro level. The insurance company is just a fundamentally better, more privileged investor than you are.
Excuse me. I read the Wall Street Journal every day.
That's great, but you don't have a general account with billions of dollars? Giant insurance companies can actively invest in asset classes that are highly illiquid and have massive duration.
Like what?
They can buy 30-year corporate paper directly. They can fund massive commercial real estate bridge loans. They can easily capture what's called an illiquidity premium that you simply cannot access buying a standard retail bond fund on Vanguard.
And because it's a mutual company structure often, they pass some of that excess premium back to the policyholders via annual dividends.
Right. So when you effectively combine that massive institutional investment power with the precise actuarial math of risk pooling across millions of lives, you get a financial product that when used correctly in de-cumulation is highly, highly efficient.
It really seems like the overarching lesson here is that traditional financial planning desperately needs to evolve.
It needs to fundamentally move from just being investment science, arbitrarily picking stocks and bonds, to embracing actuarial science. We need to start integrating life, death, and absolute certainty into the math of the plan.
So let's wrap this deep dive up with our outro. What are the core vital takeaways for the listener today?
Number one is simple. Sequence of returns risk is the final boss of retirement. Completely ignore the average returns. Respect the specific order of your returns.
If you fail in those first 15 years, you fail the entire retirement.
Number two, mitigation requires a multi-pronged approach. You absolutely need asset allocation defense. So, setting up bond tents or buckets, and you need behavioral flexibility, dynamic spending.
You have to be willing to cut back a little if the market drops. It literally saves the ship from sinking.
And number three, seriously, consider adding buffer assets. Look objectively at uncorrelated assets like whole life cash value or even setting up a home equity line of credit on your house. You need something that provides a bridge so you never, ever have to sell your stocks when they are down.
I want to leave everyone listening with a final provocative thought to chew on. We spend so much time in this industry obsessing over the safe withdrawal rate. We endlessly debate, is 4% really safe or should it be 3.5%?
Right. We just live in constant fear of running out.
But maybe safe is entirely the wrong metric to optimize for. Maybe the true metric should be efficiency. Think about it. If you were sitting on a massive pile of low-yield cash and bonds for 30 years just to blindly protect against a market crash, that might only happen once.
You are paying a huge, invisible safety tax.
Exactly. You are paying a massive safety tax in loss potential. You are living a significantly smaller, more restricted life than you actually earned with your savings.
You are essentially self-insuring against a catastrophic event. And self-insurance is mathematically the most expensive form of insurance in the world.
By formally integrating actuarial products, intentionally transferring that catastrophic tail risk to a giant insurance company, you might find you can confidently spend 60% more of your own money every year and still be completely safe.
And at the end of the day, isn't that the whole point, to actually enjoy the fruit of your decades of labor?
Absolutely. It is all about optimizing the true efficiency of every single dollar you saved. Well, that was an incredible deep dive. Hopefully, you look at your own portfolio a little differently today, not just as a random pile of stocks and bonds, but as a complex machine that needs to be precisely engineered.
Engineered for absolute survival.
Thanks for listening to Talk Tickers. We will catch you on the next deep dive.
Stay safe out there.